and it's a very much anticipated day because a lot of people have been waiting to see what the Fed's reaction has been to the high inflation that we've seen in Q1. So let's dig into a lot of the comments that Powell had today. Overall, it was a pretty good outing for us on the mortgage side for interest rate perspective. Interest rates have been rising consistently this year. Why? Because of inflation. We were expecting inflation to continue to head towards that 2% target. It was about 3.2% to start the year, now up to 3.5%, showing that it's sticky. And the Fed made comments last meeting, so about 45 days ago, that they expected inflation to come in hot in January and February. And that's where people, we saw some relief. But then it came in hot again in March. And then PCE this past April showed it hot once again. So overall inflation has been a major problem. So we've been waiting to see how is the Fed going to react to it. And overall, again, good comments from Powell pretty much highlighted that yes, inflation is a problem. 3% inflation is not acceptable. We're at 3.5 right now. They still want to get it to 2, so we're still a good distance away. And again, they said it is not acceptable. So we know we have some work to do. However, they also highlighted that they believe the policy is restrictive enough. So the Fed funds rate is 5.5. It's been 5.5 for about 9 months now. And some people have actually been calling for rate hikes because of inflation being sticky in Q1. The Fed adamant today that no, they believe the policy is restrictive enough. They are seeing that in specific sectors. Obviously, the mortgage industry, the real estate industry is seeing that restrictive policy with mortgage interest rates being the highest they've been in decades. And it's a great sign that they believe that is restricted enough, and they basically pushed any chance. Some people were pricing in maybe a 1 to 2, 3% chance of a rate hike in the future. They pretty much said it's not going to happen. There's no rate hikes in the near future. We're still just going to be at 5.5, our Fed funds rate, for the foreseeable future until we can start to see inflation come down. Or vice versa, dual mandate, they need to make sure the labor market remains strong. So other than the Fed meeting that came out today, we had a very big week. So today was also JOLTS, job openings, and was ADP unemployment survey. So let's go into those numbers. So JOLTS came in a little weaker today. It showed that job openings, which was expected around 8.7 million job openings, missed expectations by quite a bit, came in around 8.4 million job openings, a pretty big dip. And overall, we can see the trend still continues to remain low. 12.3-ish million is where we saw peak COVID, now down to 8.4. It's still some wiggle room. The pre-pandemic level was around 7 million, so big wide gap there. So Fed has some room to work with, but overall trend has been consistently lower for about a year and a half now. Then counteract that, ADP unemployment or ADP employment survey came in, and it came in hotter than expected, showing more job openings than they were expected. So we're in this weird, we're in this very unique and weird labor market that we're not seeing a lot of people quit their jobs. During COVID, you saw what was called the Great Resignation. A lot of people were leaving their jobs, and go searching out new ones. Why? A lot of wage appreciation. Also, work from home became a major thing during COVID, so a lot of people took that opportunity. Now it's the opposite. We're considering it the Great Stay. People are not leaving their jobs. And when people don't leave their jobs, it indicates what reason, right? What is the reason people don't want to leave a job? It's likely because they cannot find a job that pays them better or gives them the same opportunities. So it's the Great Stay. And we're seeing from, employers' perspectives, a lot of them do not plan on hiring at the moment. So there's not, that job openings are coming down, and employers are not needing to leave because there's no wage appreciation. So it's the Great Stay right now. And usually when you have this, it usually leads to a higher unemployment rate. Unemployment rate's at 3.8 right now. Unemployment rate comes out this Friday. Non-farm payroll comes out this Friday, so stay tuned for that. But usually you see jobless claims rise, the unemployment rates rise when people are staying at their jobs. Not seeing that. So it's a unique concept that we're in. It's kind of like the mortgage rate lock-in effect. We're seeing that from the employee-employer lock-in effect. Employees are currently staying at their job. Employers are not currently terminating people from the jobs, nor are they looking to hire. So we have this major lock-in effect leading to overall a healthy labor market, but ultimately still not where it was a year ago or 2 years ago. It's softened, and it's softened drastically. So the labor market still has a major ability to change interest rates. But right now, Fed's adamant, rate hikes are not happening, rate cuts are not happening anytime in the near future. We have to watch labor and inflation. Hopefully those continue to come down. I know interest rates are high right now. All I can say is, looking at this data, continuing to watch it week in and week out, all I can say is I am optimistic. We are close. And close does not mean next week, does not mean next month. It could be next month, right? We don't know. Non-farm payroll comes out again this Friday. Just know we are close. We're in the last innings here of these high interest rates. And again, it doesn't mean interest rates are going to come to 4 or 3 again. We just want to get to that level, that pivot level that we all know interest rates are done rising. Then maybe we'll see some relief of interest rates currently at 7.625, 7.875, come back down to 6.25 or 6.75. Some of it is around the corner. We're there. Reach out to a secure choice lending loan officer, get educated,